Every year, millions of Americans grapple with it. Tax season. It's a ritual, a certainty, often a headache. But have you ever stopped to think about why we have an income tax at all? How did this fundamental pillar of modern government finance come to be? Its journey is a dramatic tale of war, political upheaval, legal battles, and a complete reshaping of the American economic landscape. Today, we're diving deep into that turbulent history. For most of America's early history, the federal government funded itself without directly taxing individual incomes. Instead, it relied heavily on tariffs, taxes on imported goods, and excise taxes on specific products like whiskey. States and local governments typically collected property taxes. This system worked for a small, agrarian nation. But as America grew, its financial needs began to outstrip these traditional revenue streams, especially during times of crisis. The greatest crisis of all arrived in 1861, the Civil War. The Union needed an unprecedented amount of money to fund its massive military effort, far more than tariffs alone could generate. The war was costing an astonishing $1 million a day, a sum almost unimaginable at the time. This desperate need pushed lawmakers to consider a radical new idea, one that had been largely unthinkable just years before. In 1861, Congress passed the first ever federal income tax. It was a temporary measure designed solely to help finance the war. This initial tax was a modest 3% on incomes over $800. Think about that, a brand new concept applied during a nation's most trying moment, a direct levy on the earnings of its citizens. It marked a profound shift in government's fiscal policy. The initial tax was expanded in 1862, becoming slightly more progressive. Incomes between $600 and $10,000 were taxed at 3%, while those above $10,000 faced a 5% rate. This progressive structure aimed to place a greater burden on the wealthier segments of society, a concept that would resurface repeatedly throughout the tax's tumultuous history. It was truly a revolutionary approach to federal finance.
Despite the dire circumstances of the war, this new income tax was met with considerable public skepticism and outright resistance. Americans were not accustomed to the federal government scrutinizing their personal finances. Many viewed it as an intrusive and unconstitutional overreach of federal power. Collecting the tax proved challenging, relying heavily on self-assessment in an era before modern accounting or widespread record-keeping. As predicted, once the Civil War concluded in 1865, so too did the nation's brief experiment with a federal income tax. Public sentiment, combined with the decreased need for war revenue, led to its gradual repeal. By 1872, the federal income tax was entirely abolished. For a couple of decades, it seemed the idea of directly taxing personal incomes was a temporary wartime anomaly, destined for history's forgotten shelves. However, the Gilded Age brought immense economic transformation. Rapid industrialization created vast fortunes for some, while many others struggled with poverty and harsh working conditions. This widening gap between the rich and poor fueled popular discontent. The traditional reliance on tariffs disproportionately affected ordinary citizens by raising prices, leading to calls for a fairer tax system that targeted concentrated wealth. The late 19th century saw the rise of powerful populist and progressive movements. These groups advocated for significant social and economic reforms, including a federal income tax. They argued it was a necessary tool to fund government services, curb corporate power, and redistribute wealth more equitably. The idea, once a wartime emergency, was gaining new momentum as a symbol of economic justice and modern governance. Under increasing political pressure, Congress responded. In 1894, it passed another income tax as part of the Wilson-Gorman Tariff Act. This new tax was 2% on incomes over $4,000. It was designed to replace some of the revenue lost from reduced tariffs and to address the growing clamor for a more equitable tax system, directly targeting the nation's wealthiest citizens.
But this renewed attempt was swiftly challenged in court. In 1895, the Supreme Court heard the landmark case Pollock v. Farmers Loan and Trust Co. The central question, was the income tax a direct tax under the Constitution? If so, it would need to be apportioned among the states according to population, a practically impossible and unfair method for an income tax. In a shocking 5-4 decision, the Supreme Court ruled the 1894 income tax unconstitutional. The majority argued that a tax on income derived from property, like rent or interest, was a direct tax. This decision sent shockwaves through the political landscape, effectively blocking any federal income tax without a constitutional amendment. The battle for progressive taxation seemed lost, at least for a time. This Supreme Court ruling fueled public outrage, especially among progressives and farmers who saw it as a victory for the wealthy elite. The call for a constitutional amendment to explicitly grant Congress the power to levy an income tax grew louder and more persistent. It became clear that if the federal government were to ever have a stable, equitable funding mechanism, the Constitution itself would need to change. Finally, in 1909, President William Howard Taft, despite his initial reservations, proposed a constitutional amendment to address the Supreme Court's ruling. He believed an amendment was the only viable path forward, offering a clear solution to the direct tax controversy. This marked a crucial turning point, moving the debate from legislative acts to a fundamental change in the nation's founding document. The proposed 16th Amendment faced a grueling ratification process. It required approval from 3/4 of the states. The debate was fierce, pitting states' rights advocates against those who saw the income tax as essential for modern governance and social justice. However, the progressive tide was strong, and the need for a stable revenue source for an expanding federal government was increasingly recognized.
On February 3, 1913, Delaware became the 36th state to ratify the 16th Amendment, officially making it part of the United States Constitution. It declared, "The Congress shall have power to lay and collect taxes on incomes from whatever source derived, without apportionment among the several states, and without regard to any census or enumeration." The legal hurdle was finally overcome. With the constitutional barrier removed, Congress wasted no time. Later that year, the Revenue Act of 1913 was passed, establishing a permanent federal income tax. Initial rates were still relatively low, a 1% tax on net personal incomes over $3,000, with a progressive surtax reaching 7% on incomes over $500,000. It was a modest beginning for a monumental change. Just as the new income tax was taking root, the world plunged into World War I. This global conflict dramatically escalated the federal government's financial demands. To fund the war effort, Congress rapidly increased income tax rates and significantly lowered the exemption thresholds, drawing millions more Americans into the tax net. What started as a modest levy on the wealthy now began to affect middle-class families. By the end of World War I, the income tax had transformed from a tax on the rich to a mass tax. Millions of ordinary Americans were now paying federal income taxes, and it had become the single largest source of federal revenue. This shift fundamentally altered how the government financed itself, providing an unparalleled capacity to mobilize resources for both wartime and future domestic programs. The Great Depression of the 1930s brought another surge in federal spending as the government implemented New Deal programs to combat economic hardship. The income tax became even more vital, helping to fund these massive relief and recovery efforts. It was increasingly seen as a flexible tool that could be adjusted to meet national emergencies and address widespread societal needs. World War II cemented the income tax as a universal obligation. To fund the largest war effort in history, Congress introduced payroll withholding in 1943. This made tax collection far more efficient, as employers automatically deducted taxes from paychecks. The income tax became a fixed part of almost every working American's life, generating unprecedented revenue for the war. After World War II, the income tax remained the primary engine of federal finance. Its massive revenue stream funded not only defense spending during the Cold War, but also the expansion of the American welfare state. Social Security, Medicare, and extensive infrastructure projects became possible on a scale unimaginable before the income tax provided such consistent and substantial funding. Of course, this powerful tool brought with it immense complexity. The Internal Revenue Service, or IRS, grew into a formidable agency responsible for administering the intricate tax code.
The sheer volume of regulations, deductions, and exemptions made tax preparation a perennial challenge for citizens, leading to a specialized industry of tax professionals and software. To this day, the income tax remains a subject of intense debate. Questions of fairness, progressiveness, economic efficiency, and the proper role of government in wealth redistribution continue to dominate political discourse. Proposals for reform, from flat taxes to national sales taxes, frequently emerge, each aiming to address perceived inequities or inefficiencies within the current system. But regardless of the ongoing debates, the income tax fundamentally changed America. It transformed a limited federal government, constrained by tariffs, into a powerful engine capable of massive social programs, global military projection, and economic stabilization. It's a story of how a wartime necessity became the enduring backbone of a nation's finances, proving that crisis truly can be the mother of economic invention.